Welcome to Indianomics. The US 10-year Treasury yield has been rising for 5 consecutive months now since April. If October witnesses another surge in yields, it will mark the longest monthly streak of increases since 1999. So this is historic. What is significant is also the extent of the rise. From around 3.5% in end April to 3.7% in May, 3.85% in June, to almost 4%, 3.95% actually in July, to an average of 4.1% in August and almost 4.6% in the last day of September. October began with one peep above the 4.8% mark. On an average, the yields have risen by 130 basis points in the last 5 months. While this is bound to have implications for growth and maybe loan defaults in the US, the 10-year Treasury is also the default benchmark cost of capital for the world. And hence, there are bound to be repercussions on monetary policies and exchange rates for most countries. To assess the reasons for this sharp rise, the future trajectory of the cost of capital, and the impact on all countries in the global economy, I have with me 3 top-notch economists: Brian Coulton, the chief economist at Fitch Ratings; Robert Sockin, the global economist from Citi; and Aditya, Bhave, the senior US economist from Bank of America. Gentlemen, thank you very much. This is various time zones, so good evening and good morning, good afternoon as the case may be. Brian, first to come to you. What would you say is the prime cause? Is it the Fed indicating in the September dot plot that it intends to keep rates higher for longer and will cut very late and much less? Or is it more a fiscal problem?
I think it's a combination of the two. I think some of the earlier increases that you were referring to through August and September were probably largely about the Fed's message of higher for longer on rates. They're not going to be cutting rates quickly. And as that was happening, the market was kind of pricing out the view that the US would go into recession. I think more recently, though, we're seeing some concerns that if you look at what's going on with the rise in rates, it's more about real interest rates rising, and it's partly about the term premium, the difference between the yield and the so-called neutral rate, sort of, what the market expects rates to be over the next 10 years. And that's kind of pointing to us that maybe there's some increasing concerns in the market about the future supply of treasuries being very large because of outsized fiscal deficits, which look set to continue for a long time. So I think it's these supply issues that are now pushing up the real yield.
Okay. Your thoughts, Robert? If it is a question of term premium being impacted by future supply, then this is not going away very quickly. So your thoughts on to what extent is the fisc contributing to this increase in yields, and therefore how long do you expect the yields to continue to climb?
Yeah, thanks so much for having me. And this is a great question. On the term premium side, I think what we're seeing, our view as well, is that most of the move that we've seen maybe up until recently has largely been driven, as Brian was talking about, to monetary policy expectations, the idea that growth is stronger. The Fed's probably going to have to stay higher for longer, the more resilient the economy is. And you saw that messaging from the Fed in their most recent dot plot, where they removed some of the cuts from next year as they started to upgrade growth. So I think that's been a big driver of it. But also there's this fiscal question in the background. And we do hear a lot of concern about this from clients. And if you look at the numbers, they are quite striking. We know the Fed is running off its balance sheet, so more of the supply is going to have to be bought by the private market. And we're running very large deficits. We're set to average deficits of 6% over the next several years, and that compares with deficits of around 3.5% in the years before COVID. So when you look at these numbers, they're very large, and we do think that in order to get the type of 10-year yields that you're having right now, you have to get some type of pickup, big pickup in the term premium. Now, maybe supply isn't driving all of that. It's really hard to tell the extent to which supply is driving up these yields. But it's certainly a story that people are focused on. I think if you look back to early August, that's when you really saw investors start to focus on this more, with the Treasury refunding, showing that issuance was going to have to step up significantly, and the Fitch downgrade, which brought to bear to investors' minds these fiscal challenges. I would make just one additional point, which is I don't think the market is fully aware of how much they should really be baking into the term premium, or hasn't really fully decided it. I mean, the fact that we're getting on second tier data like ADP, we're getting 10 to 15 basis points type move in Treasury yields really shows that the market is struggling to think about what the right pricing is here.
That's my point. That's why I was trying to distinguish between the monetary reasons and the fiscal reasons. If it's only a question of monetary, if the prime trigger was monetary, then any sight of bad news will be good news for bonds. But if it is a demand-supply mismatch, then we are likely to see the term premium continuing to rise. What's your take, Aditya? Do you think there is not just a supply issue, there is also a demand issue? Like Robert said, the Fed isn't a buyer anymore, it's actually a seller in a sense. And then, Japanese funds have their own JGBs to buy because the yields are at 10-year highs. A lot of emerging market countries are a little shocked by the recognition of Russian reserves, and they're also trying to diversify into gold. So is there a demand-supply mismatch? And therefore, Aditya, do you think yields can go above 5% or more simply because of the demand-supply mismatch?
Right. So I think all of the points that were raised are valid, right? There's a term premium issue, there's a fiscal issue, there's concerns that higher Fed policy rates are structural rather than cyclical, and those concerns have been growing. There's the continuation of quantitative tightening. So all of these factors are contributing to the increase in yields. The one thing that I would add is that these factors are not necessarily mutually independent. Right. So to the extent that the budget deficit continues to be elevated, that's expansionary in some ways, and the Fed would have to lean against that. So if a high budget deficit is structural, then higher Fed policy rates are also potentially structural, right? That can raise R star, and those can feed into one another and not only raise the 10-year rate for their own reasons, but also, together, and then impact the term premium, because all of this creates a lot of uncertainty around the outlook.
Now, I want all of you experts to tell me where we can see it head. Brian, that question to you. Do you get a sense that yields have still more to go because the fiscal demand-supply mismatch is perhaps yet to play out? There will be more treasuries that the Fed will have to issue because of the commitments that it has got into. So can we go beyond 5 and stay there?
Yeah, I mean, there's lots of different moving parts here. And I would say, one thing that we feel is that the Fed is maybe a little bit too optimistic on the path for the US economy. They really don't have much of a slowdown in growth at all. So our view would actually be that the US economy would weaken quite significantly in the first half of next year, and we're actually still forecasting a mild recession. So that would take some pressure off the labour market and might lead to some reassessment of this view that the Fed has set out in the dot plot. But I have to say, frankly, if we are wrong and the Fed is right on the US growth outlook, I think there is a real risk that the Fed has to take the policy interest rate above 6%. And on that scenario, I definitely see the 10-year yield breaching 5%. Now, that's not our base case view, but if we prove if it proves that the Fed is correct on US growth and there's a lot more dynamism in the economy in next year than we think there's going to be, I think the Fed is not done with one more hike, which is our base case view, but actually it could be 2 or 3 more. And on that scenario, definitely, I think see that the 10-year above 5% is a real possibility.
You guys at Fitch would be looking at the fiscal numbers even more closely than perhaps Robert and Aditya, I mean, since you'll rate sovereign paper. So that's why I'm asking you, Brian, yet again, that can the lack of enough buyers or a surfeit of supply overwhelming supply, push the yield above 5%. I mean, what's your view on yield itself, the 10-year yield? Do you think it can stay above 5%?
Our base case would be that it would come off early next year, because, as I say, we're expecting the economy to weaken, and we think that will allow the Fed to start cutting rates next May, and they will cut several times. That's our base case view, and on that view, I think the 10-year would come off, because the interest rate outlook would then change significantly, and that would bring the 5-year down. But I'm just highlighting that there is a real risk that we don't see that scenario. But our base case view, I think, would be that the 10-year would come down. You've got to remember, this is the most liquid bond market in the world, and in a sense, these changes in yields themselves will potentially unlock some additional new demands. So okay. I wouldn't want to overdo the supply concerns. Okay. I do think that's been part of the recent story, but I wouldn't want to overdo the weight of supply. Even though quantitative tightening is a big deal. The changes in Japan are a big deal, but this is the most liquid bond market in the world, and so changes in prices and changes in yields do lead to a response on the demand side. So let's not get too concerned. Okay. It's not like an emerging market where if there's big deficits, definitely pushes the price down.
I take your point on that entirely. I mean, we are beginning to see slight slowdown in remittances from Indians living abroad. And our guess is that's because the dollars are earning a decent amount of money abroad, and therefore, there will be buyers. I take your point. I want the view on US 10-year yields from Aditya and Robert as well, but I have to take a quick commercial break. Back in a jiffy.
Dinosaur's egg.
Oh.